welcome to the Bravo Trade Academy Global, and you are now with Coach Mukmik, and today I will be taking you through the reversal candlesticks and how to use them. Firstly, you need to know what are the most important things that you need to be cautious about before using the reversal candlesticks, alright? So what I have for you here is the 3 things that you need to keep in mind. So the first one is the trend, and the trend that you need to know is actually the trend in a larger time frame. For example, the 1 hour time frame, the 4 hours time frame, daily time frame, and weekly time frame, okay? And that's the major trends that you need to know, okay? The second thing is the area to notice the reversal candlestick, okay? So if you are going for entering a trade, you will need to know what's the technique that you use here. So the first reversal candlestick, if it doesn't actually appear at the significant area that is your plan, so that's not significant. But the significant area would be the supports, the resistance, and also the zones that we use, which are the demand and the supply zones, okay? And the third thing is the time frame. Alright, so the time frame that we will be using is the time frame that is larger or higher than the minutes time frame. So I would say the smallest time frame that you could use is the 1 hour time frame, okay? Now you know what to notice even before noticing the reversal candlesticks, okay? So next we are going to talk through the reversal candlestick patterns, okay? The first one is the single candlestick that we would be, notice. The easiest one, and I bet that every one of you have heard about this, is the doji candlestick. So the doji candlestick, if you can tell, the close price and the open price is really, really close together. So it almost making the plus sign, okay? So if the doji candlestick is formed at a resistance, there's a chance that the chart will be reversed from an uptrend, like so, have a doji here, to a downtrend, okay? And on the other hand, if this formed at the supports, there's a chance also that the price might change from being a downtrend, have a doji here, and reverse itself into an uptrend. Okay, so that's for the doji ones, really easy. For the second one is the shooting star. So the shooting star must form at the resistance only. Okay, why is that? Because the price coming up, test the resistance, a lot of selling power here that makes the wick of the candle is really long. That's why that we need to notice this one only at the resistance. And it would tell us that, okay, the price might turn itself from an uptrend to a downtrend. Alright, easy peasy. The last one for the single candlestick would be the hammer. Okay, the hammer is like kind of the hammer that you use in your garage, okay? So the hammer must be formed at this support only, okay? Why is that? Is the other hand side of the resistance. So if the hammer is formed at the supports, what it tells you that the price might coming back from being a downtrend, and then it has a lot of buying power that formed the lower wick of the candlestick. The price have been chewed up and closed quite high, okay? Closed quite high. And that makes this picture having the chance that the price will be reversed from being a downtrend to an uptrend. So that's for the single candlestick, okay? That's done. We're going to the double candlesticks pattern that we've got for you. So there are two patterns that I use most. Alright, so the first one is the piercing bar. So the piercing bar, how could you notice that? So the first thing that you need to notice is the second low, which is the low of the second candlestick, is lower than the first low. Alright, and also it needs to close. So this is the close price of the green candlestick, right? Over 50% of the first candlestick. Okay? So that's the pattern that you can notice, and it must be formed at the support. So if it forms at the supports, it must tell us that, okay, the price will turn itself from a downtrend to an uptrend. Okay? That's the piercing bar. So let's go to the dark cloud cover. So the dark cloud cover is the twisted story from the piercing bar. So the dark cloud cover, you can notice from the second high, this time you need to notice the high. So the second high of the second candlestick is higher than the first candlestick, and it must be closed. So the close price of the red candlestick is below, right? So it must be closed below 50% of the first candlestick. And this dark cloud cover needs to be formed at a resistance. So what does it mean? So if it's formed at the resistance, there's a lot of chance that the price will turn itself from an uptrend into a downtrend. So that's done for the double candlestick. Easy peasy. Last thing is the triple candlestick pattern that we have for you. So this one I use a lot. You know, if you've been following me on the technical analysis on the gold, I always use the reversal bar. We have the bullish and the bearish reversal bar. And this is really significant because you have 3 candlesticks to confirm, okay? So for the bullish reversal bar, what you can notice is that the second low, the low of the second candlestick, is lower than the first low. And the close price of the second candlestick is higher than the first one. So the close price of the green, okay, is higher than the first low. So the first low is here. So that tells us, okay, this candlestick might be a reversal bar. However, you do need another candlestick to tell that this one is a reversal bar, okay? And the thing is, the second and the third candlestick must be a bullish one. Why is that? Because it tells us that, okay, the buying power is here, okay? So you can make a buying plan here. And this one must be formed at a support as well. And we are looking for a buy here if you have the bullish reversal bar, okay? So it tells us that there's a chance that the price will turn itself from being a downtrend to an uptrend. That's done for the bullish one. Okay, so for the bearish reversal bar, it is another way around. So what we have here is the second candlestick. So the second high of the second candlestick is higher than the first candlestick, okay? And the close price must be lower than the first candlestick, okay? And the important thing that we need to be careful is that the second and the third candlestick need to be a bearish one. So that confirms that, okay, the selling power is here, okay? And these candlesticks must be formed at a resistance. And it tells us that, okay, there's a chance that the price could be reversed from being an uptrend to being a downtrend. That's done for the reversal candlesticks. I hope you enjoy learning with me, and I hope you did get something new from this video. If you do, please give it a thumbs up and share it with your friends. And also, please click the subscribe button for us. Thank you very much, and I will see you for the next knowledge that I will coming out and, talk you through it. Bye.